Michael Oliver, a market analyst whose technical work correctly identified the 1987 market crash before it happened, has just issued targets so extreme they're forcing even skeptical investors to pay attention. His minimum projection, $500 per ounce for silver. His timeline, this summer, as in 4 to 5 months from today. But what makes this forecast different from typical market predictions is the framework behind it. Oliver doesn't analyze price charts the way conventional traders do. He doesn't chase headlines or follow sentiment surveys. His momentum structural analysis examines the underlying architecture of market movements, identifying transformations that unfold over years before most investors even notice. And according to his latest analysis, silver has just completed what he calls a rebirth following the recent price correction. The structural foundation that was being built through volatility is now locked in place. What comes next, he argues, is a move so powerful it will redefine how investors think about precious metals. In the next several minutes, I'm going to walk you through exactly what Oliver is seeing in his momentum indicators, why he believes this correction actually strengthened silver's trajectory rather than weakening it, and what his analysis reveals about gold's path toward $8,000 per ounce. More importantly, I'll show you why he thinks the opportunity window for positioning is measured in weeks, not months. Let's begin with what just happened in the silver market, and why it matters more than the price action suggests. Between late January and early February, silver experienced a violent correction. From peak to trough, the metal fell approximately 18% in just days. Retail investors panicked. Social media filled with claims that the rally was finished. Traditional technical analysts pointed to overbought indicators as proof that silver had gone too far too fast. Michael Oliver saw something completely different. In his framework, corrections during major structural bull markets serve a specific function. They don't signal weakness. They create what he describes as structural reinforcement. Think of it like a building under construction. Before you can add additional floors, you need to pour a stronger foundation. The recent sell-off, according to Oliver's analysis, was that foundation building process. Here's the critical distinction. During typical cyclical rallies, corrections lead to prolonged consolidation periods. Markets drift sideways for months while participants debate whether the uptrend is intact. Momentum indicators deteriorate. The recovery, if it comes, lacks conviction. That's not what happened with silver. Oliver's momentum structural indicators show that silver's underlying force remained intact throughout the entire correction. The price fell, yes, but the market's internal architecture never broke down. Within days, silver began recovering lost ground. The snapback wasn't gradual. It was immediate and powerful. This behavior reveals who the dominant buyers are and what their intentions are. Short-term speculators exit during corrections. They're the ones who drive prices down sharply when volatility strikes. But structural buyers, the industrial manufacturers who need physical metal, and the institutional investors building long-term positions, view these drops as entry opportunities. When these structural buyers absorb selling pressure within days instead of months, it tells you the market's character has fundamentally changed. Oliver describes what we are witnessing now as silver entering a new reality, where old trading patterns no longer apply. The correction didn't damage silver's trajectory, it validated it. And if his momentum indicators are correct, the acceleration phase that follows this type of structural reinforcement is where the most dramatic price gains occur. To understand why Oliver's target seems so extreme, you need to understand how his analytical framework differs from conventional technical analysis. Most traders look at price charts and try to identify support levels, resistance zones, and trend channels. They use indicators like moving averages and relative strength indexes to determine whether an asset is overbought or oversold. When these indicators flash warning signals, they reduce positions or exit entirely. Oliver argues this approach is fundamentally flawed during structural market transformations. He uses an analogy. Watching price is like watching your car's speedometer. It tells you how fast you're currently going, but it reveals nothing about the engine's power or whether you're about to accelerate or decelerate. Momentum. Structural analysis, in contrast, examines the engine itself. His system measures the underlying force driving price movements across multiple timeframes. When momentum begins building in a market that has been structurally suppressed for decades, the indicators show a pattern he's seen repeatedly before major bull market explosions. He saw it in copper before its massive run in the 2000s. He saw it in lead before its 18-month tripling. And he's seeing it now in silver, but with readings that suggest a move larger than either of those precedents. According to Oliver, silver's momentum structure has broken through resistance levels that have contained the metal for over 40 years. This isn't a minor technical breakout that might reverse in a few weeks. This is a multi-decade ceiling being shattered. And when that happens, the price doesn't simply drift higher. It gaps violently upward to reach levels it should have hit years ago, if not for artificial suppression. He calls this phenomenon lightning form repricing. Decades of pent-up pressure releasing in compressed time. It's not gradual, it's not orderly, it's explosive. And according to his current momentum readings, we're in the early acceleration phase right now. The move hasn't even approached its most parabolic stage yet. One of the most powerful dynamics supporting Oliver's forecast is the relationship between gold and silver, measured through what analysts call the gold-silver ratio. This ratio simply tells you how many ounces of silver are required to buy 1 ounce of gold. With gold at $4,966 and silver at $76.89, that ratio currently sits near 65 to 1. Historically, this ratio averages around 50 to 1 over extended periods. But during precious metals, bull markets, something remarkable happens. The ratio doesn't just drift toward its average, it crashes dramatically, sometimes falling to 30 to 1, 20 to 1, or even lower during mania phases. Why does this matter? Because it reveals silver's leverage compared to gold. Silver is a far smaller market than gold in terms of total value. When capital flows into precious metals, silver's price must move much more dramatically to absorb those flows. It's basic mathematics applied to market capitalization differences. Oliver's technical work shows that a critical resistance level in silver's performance relative to gold has been breached. This same pattern appeared before the 1979 to 80 explosion, when silver rose nearly 5 times in 5 months. It appeared again before the 2010 to 11 rally, when silver more than doubled in 7 months. Now it's happened a third time. But according to Oliver, the structural base supporting this breakout is wider and stronger than either of those historical precedents, suggesting the potential for an even larger percentage move. Let's run the mathematics on what this means for price targets. If gold reaches $8,000, which would match historical bull market multiples from its base, and the gold-silver ratio compresses to 20 to 1, as it did in 1980, silver would trade at $400 per ounce. Even with more conservative assumptions, if gold hits $6,000 and the ratio drops to 30 to 1, silver reaches $200. Oliver's minimum target of $500 implies either an even higher gold price, a more extreme ratio compression, or both occurring simultaneously. These aren't random numbers pulled from imagination. They're mathematical projections based on momentum readings, historical precedent, and market structure analysis. The real question isn't whether such moves are possible. History proves they are. The question is whether the structural conditions exist right now to support them. And Oliver's answer, based on 40 years of analyzing commodity cycles, is unequivocal. Yes. While silver's technical structure is compelling, there's an equally powerful fundamental story unfolding that most investors are completely missing. For at least 5 consecutive years, global silver consumption has exceeded production. We're running a structural deficit of approximately 200 million ounces every single year, and this gap is widening, not closing. Why? 2 reasons, and both are accelerating. First, industrial demand is exploding in sectors where silver is irreplaceable. Solar panel manufacturing requires silver's unique conductive properties, with global solar installation capacity expanding at unprecedented rates. Particularly in China, which produces 80 to 90% of the world's panels, this single sector is consuming massive quantities. Artificial intelligence infrastructure is driving construction of enormous data centers. These facilities require sophisticated electrical systems where silver plays a critical role in connections, switches, and thermal management. The AI revolution isn't slowing down, it's accelerating, and every new data center being built increases structural silver demand. Electric vehicle production uses significantly more silver than traditional internal combustion vehicles. As global automotive fleets electrify, this demand vector continues climbing. It's not cyclical demand that disappears during recessions. It's structural demand that persists regardless of economic conditions. Medical devices, advanced electronics, smartphones all require silver. This is non-discretionary industrial consumption that cannot be easily substituted. Second, supply cannot respond quickly enough to meet this demand surge. Mining isn't like turning on a faucet. Discovering a new silver deposit, securing environmental permits, raising capital, building infrastructure, and bringing a mine into production requires a decade or more. Years of suppressed silver prices discourage the massive capital investment needed for new mining projects. Existing operations are depleting their highest grade ore bodies. Recycling, while helpful, cannot bridge a 200 million ounce annual deficit. This is the setup for what Oliver describes as lightning former pricing. When markets ignore fundamental deficits for extended periods, the eventual price adjustment doesn't happen gradually. It happens violently and rapidly as price catches up to where it should have been all along. The deficit was building quietly while silver traded in the 20s and 30s. Now, with silver above $70, the deficit still exists. The market is only beginning to price in the reality of structural scarcity. Let me give you some concrete evidence from just the past few weeks that validates what Oliver's momentum analysis is indicating. COMEX, the major commodities exchange, reported delivery notices in January that were 3 times higher than the entire month of January last year. This signals intense demand for physical metal, not just paper speculation. The exchange introduced a new 100-ounce silver futures contract specifically to meet what they described as record retail demand. Think about that. The exchange itself is acknowledging unprecedented interest from smaller investors, and they're creating new products to handle the volume. Margin requirements at COMEX were increased and restructured from fixed dollar amounts to 9% of notional value. This is the exchange preparing infrastructure for much higher price levels and volatility. In China, the Shanghai Futures Exchange saw silver prices approach $100 per ounce at certain points, showing significant premiums over Western markets. This reveals regional supply tightness and buying pressure that Western traders aren't fully recognizing yet. The United States Mint announced a 1-month delay on 2026 American silver eagle coins. When they were finally released, they sold out immediately. This is the official government mint unable to keep pace with demand. Retail dealers like APMEX briefly saw prices for bulk purchases of American silver eagles touch $99.69 per coin. That's a premium of over $20 above spot price. When premiums expand to that degree, it signals physical shortage conditions developing in retail markets. Perhaps most significantly, the United States Treasury Secretary convened a ministerial meeting focused specifically on securing critical mineral supply chains, including silver. This is high-level government recognition that silver is now classified as a strategic resource with national security implications. These aren't predictions. These are documented market events happening right now, in real time, validating the supply-demand imbalance that Oliver's analysis suggests will drive prices dramatically higher. Beyond silver's individual dynamics, there's a broader monetary shift occurring that amplifies the precious metals thesis. Major economies, including the United States, Japan, and the United Kingdom, are grappling with government debt levels that have become mathematically unsustainable. This isn't political commentary. It's observable reality in debt-to-GDP ratios and deficit projections. When government bond markets become unstable, central banks face an impossible choice. They can allow yields to spike, which would trigger economic collapse and make government debt service costs unbearable. Or they can intervene by purchasing bonds themselves, which requires creating massive amounts of new currency. They're choosing intervention. And intervention means currency debasement on a scale we've never witnessed in modern history. In this environment, investors seek assets that exist outside the debt-based financial system. Physical commodities with thousands of years of monetary history become safe harbors when fiat currencies are being deliberately devalued. We're already seeing this dynamic unfold. Central banks globally have been accumulating gold at record levels for 3 consecutive years. Sovereign wealth funds are building strategic precious metals reserves. This represents a fundamental vote of no confidence in the current monetary system's sustainability. Oliver's analysis suggests we're entering a commodity supercycle similar to the 1970s, but amplified by factors that didn't exist 5 decades ago. The industrial demand drivers I outlined earlier, solar, electric vehicles, AI infrastructure, simply weren't present in the 70s. The monetary crisis is more severe. The debt levels are larger. The currency debasement is more aggressive. When that capital flow from financial assets into tangible stores of value accelerates, and Oliver believes we're in the early stages of that acceleration right now, it creates enormous upward pressure on gold and silver prices. His gold target of $8,000 isn't based on speculation. It's based on historical bull market multiples applied to current structural conditions. And if gold reaches $8,000, the mathematical implications for silver through ratio compression are staggering. While physical silver and gold offer substantial upside, Oliver specifically highlights that junior mining companies present what he calls the greatest opportunity, using the word especially to emphasize where he sees the most dramatic returns. Consider the profit leverage mathematics. A mining company producing silver at a cost of $20 per ounce, selling into a $77 market, makes $57 profit per ounce. If silver rises to $300, that same miner now makes $280 per ounce. Profits haven't tripled. They've increased roughly 5 times. Mining company stock prices typically move 3 to 5 times the underlying profit expansion. A 5-fold profit increase could drive share prices 15 to 25 times higher. In reality, during mania phases, the multiple expansion can be even more extreme. This leverage effect has been demonstrated repeatedly in commodity bull markets. During the uranium boom of the early 2000s, uranium prices rose 7-fold. The best-positioned junior uranium mining stocks rose 50-fold or more. In the lithium explosion that peaked in 2022, lithium prices increased 13 times. The best junior lithium miners saw gains exceeding 100 times their base valuations. Oliver's emphasis on junior miners isn't casual commentary. It is a deliberate signal about where he believes the most explosive returns will occur during this silver cycle. However, selectivity is absolutely crucial. Mining companies vary enormously in quality. Some have hedged their production, capping upside. Some operate in politically unstable jurisdictions, where nationalization risk is real. Some have incompetent management teams that will squander the opportunity even in a bull market. The opportunities lie with unhedged producers operating in stable countries like Canada, the United States, and Australia, with competent management teams, strong balance sheets, and quality assets in districts with expansion potential. These represent high-risk, high-reward investments suitable only for the aggressive portion of a portfolio. But for investors who can tolerate extreme volatility and have conviction in the underlying thesis, the potential returns are extraordinary. Before anyone rushes into silver investments based on Oliver's forecast, there's a critical reality that must be understood and accepted. This market will be violently volatile. Rick Rule, a legendary resource investor with over 5 decades of experience, offers sobering historical perspective. During the 1970s gold bull market, even as prices ultimately climbed from $35 to $850, there was a 50% correction in the middle of the advance. Imagine experiencing that. You're positioned in what turns out to be a historic bull market. Prices have already doubled. And suddenly, you're watching half your gains evaporate over several months. The investors who panicked and sold during that correction missed the subsequent move from around $125 to $850. They missed a nearly 7-fold gain over the following 6 years. Rule states with absolute certainty that silver will experience at minimum a 25 to 30% correction at some point during this bull market. Not might experience, will experience. These corrections serve a purpose in bull markets. They shake out weak hands and speculators who lack conviction. They create opportunities for strong hands to accumulate at better prices. They reset sentiment, so the next leg higher doesn't start from a position of universal optimism. The recent correction demonstrated this pattern perfectly. Silver fell 18% from its peak. Panic selling emerged, and within 10 trading sessions, the entire decline had been erased. Those who sold in fear locked in losses. Those who held or bought the dip were rewarded. Is silver the next big thing in the investment world? Many of you have been asking about it, and today we are diving deep into some fascinating research that suggests a major move could be on the horizon. We're going to explore the work of Michael Oliver from Momentum Structural Analysis, who's been tracking some very interesting patterns in the silver market. So if you're curious about precious metals or looking for the next potential opportunity, you're in the right place. Now let's get straight to it. Michael Oliver isn't your typical market analyst who just looks at price charts. He focuses on momentum. Think of it like this. Price tells you where an asset has been, but momentum can tell you where it's going. It's about the energy and force behind a price move. For years, Oliver has been pointing out a massive multi-year base structure that silver has been building. Imagine a coiled spring, getting tighter and tighter, just waiting to be released. That's the picture he paints for silver. So what's the big deal with this base? Well, according to Oliver's analysis, silver has been trading in a relatively defined range for a long time. It's been consolidating, building up strength. He identified a key breakout level, a line in the sand that, once crossed with conviction, could signal the start of a massive new uptrend. For a while now, silver has been flirting with this level, testing it, poking its head above it, but not quite making that decisive, sustained break. The fascinating part of Oliver's work is how he compares silver to other assets, especially gold. He uses what he calls a momentum ratio to compare the two. This isn't just about the gold to silver price ratio you might hear about. This is about comparing their underlying momentum, their internal strength. And for a long time, gold's momentum was leading the charge. But recently, Oliver's charts have shown a significant shift. Silver's momentum has started to outperform gold's. This is a critical signal. It suggests that the leadership within the precious metals complex could be rotating from gold to silver. Why is this rotation so important? Historically, when silver takes the lead, it tends to move much more explosively than gold. It's the more volatile, more speculative of the two. So when it finally breaks out of a long-term pattern and starts outperforming gold on a momentum basis, the moves can be dramatic. Oliver has highlighted similar patterns from past bull markets where Silver's outperformance signaled a much broader and more powerful rally for the entire precious metal sector. Let's look at the bigger picture for a moment. What are the fundamental drivers that could support such a move? We're living in a time of incredible monetary expansion and persistent inflation concerns. Central banks around the world have been printing money at unprecedented rates. This devalues fiat currencies and makes tangible assets, like silver, more attractive. Silver isn't just a monetary metal, it's also a critical industrial metal. It's used in solar panels, electric vehicles, and countless electronic devices. This dual demand, investment and industrial, creates a very compelling backdrop. As the world pushes towards green energy and further electrification, the industrial demand for silver is set to grow significantly. So you have this fundamental story of increasing demand and a potentially constrained supply, and then you have Michael Oliver's technical momentum work lining up perfectly with it. He points to specific momentum trigger levels. For example, he might say that if silver closes above a certain number on its annual momentum chart for a specific period, it confirms the breakout. This isn't just a guess, it's a disciplined, rules-based approach that removes a lot of the emotion from market analysis. It's about waiting for the market to prove itself. When Oliver's momentum indicators for silver finally tripped their long-term buy signals, he suggests the character of the market will change completely. The slow, grinding action we've seen for years could be replaced by a fast, powerful upward trend. He describes it as a rip-your-face-off rally. This is when the institutional money, which has largely been on the sidelines, will be forced to chase the price higher. They can't ignore a major asset class that is clearly in a new bull market. This is what creates those parabolic moves that can generate life-changing returns for early investors. Now, of course, no investment is without risk, and analysis is not a guarantee. The market can be unpredictable. But what Oliver's work provides is a roadmap. It gives you key levels to watch and a framework for understanding the market's internal dynamics. It's about probabilities, not certainties. The thesis is that silver has completed its long-term correction and basing process. It has weathered the storm, shaken out the weak hands, and is now ready for its next major leg up. The recent action, where silver has pushed up and held its gains, is seen as very constructive. It's behaving exactly as it should if a major breakout is imminent. Think about the psychology of the market. For years, investors have been frustrated with silver. It's been called poor man's gold and has underperformed many other assets. This kind of negative sentiment is often what you see at the bottom of a major cycle, right before a significant turn. When everyone has given up hope, that's often the best time to get interested. The fact that silver is now starting to show signs of life, confirmed by the objective momentum data from analysts like Michael Oliver, should make every serious investor pay very close attention. So, to recap the key points from Oliver's perspective, first, silver has built a massive multi-year momentum base, like a coiled spring. Second, it's starting to outperform gold on a momentum basis, a classic signal that often precedes a major rally. And third, once specific long-term momentum levels are decisively broken, it could trigger a rapid and powerful move to the upside, attracting a flood of new investment capital. This is a story that has been building for years, and it looks like we could be at a major inflection point. Keep an eye on those key levels. Watch how silver behaves relative to gold, and consider the powerful fundamental tailwinds of inflation and industrial demand. The evidence is mounting that something big is brewing in the silver market. It could be one of the most exciting investment stories of the coming years. Thank you so much for watching. I hope this breakdown of Michael Oliver's work on silver was helpful and gave you some food for thought. If you enjoyed this analysis, please hit that like button and subscribe to the channel for more deep dives into the markets. I'd love to hear your thoughts on silver in the comments below. See you in the next video.